we can examine how interest rates vary according to maturity, that is, how interest rates for short-term periods are different for interest rates for long-term periods, by looking at the term structure of interest rates. The term structure of interest rates is the relationship between the maturity, or the length of the investment, the length of the loan, and the return for bonds with similar levels of risk. Typically, we examine the term structure of the interest rates graphically, looking at the yield curve. The yield curve captures the relationship between maturity and the yield, known as the yield to maturity, on the particular debt securities. So, a yield curve, on the horizontal axis, we'll put the time to maturity. For example, we could have a U.S. Treasury that matures in 3 months, or U.S. Treasury bond that matures in 30 years. And on the vertical axis, we put the yield to maturity. In other words, what is the rate of return that the bond is currently paying at the given price. And we can see that across time, from this example in figure 6.3 in the textbook, that the shape of the yield curve changes dramatically across time. So if we were to look back in May of 1981, where we saw really high short-term rates and still quite high long-term rates, but the long-term rates were less than the short-term rates. We might ask ourselves, well, that doesn't really make sense, does it? Because you would think most investors would demand a higher rate of return the longer they're going to tie up or the longer they're going to invest their money. But they didn't in this case. However, can you think of a reason why you would want to lock in money long-term at a rate lower than what you could invest in at the short term? In other words, why back in May of 1981 you might be happy to have made this investment for 30 years at a rate lower than the 3-month rate? Well, you might be happy to tie this in at this high rate for the next 30 years if you think interest rates are going to fall in the future. And that's precisely what was happening there. They expected interest rates to fall in the future. Why would interest rates fall going forward? Well, one of the reasons they would fall is if there was an expectation that the economy would not be doing as well, and that interest rates would fall because there would be less demand for loans because businesses would be pulling back on their investments and they did not need debt financing, so the demand for funds would decrease, which happens typically when we're heading into a recession. Also, when we go into a recession, the Federal Reserve typically tries to cut interest rates to try to spur investment. So a downward sloping yield curve like we see here is very often, not always, an indication that long-term rates are expected to fall in the future. And if we look in September of 1989, we see almost a flat yield curve, where long-term rates and short-term rates are very similar. And we'll get back to that in a little bit. And then in May of 2013, we see more what we expect, and this is what we see most of the time. We call this an upward sloping yield curve, where short-term rates are less than long-term rates. And we typically interpret this as investors are demanding a higher compensation for taking on maturity risk, in other words, investing their money for longer periods of time, and that investors view that going forward, investments are going to yield higher rates of return. We could also examine the yield curve over time with something called a dynamic yield curve. So here is a dynamic yield curve. On the left-hand side of the page, we have a typical term structure of interest rate yield curve depiction with the time to maturity of the instruments on the horizontal axis, and on the vertical axis the yield to maturity. And on the right-hand side, we have the stock market as proxied by the S&P 500 and how it's performed across time. The S&P 500 is an index of the 500 largest firms in the United States and proxies as a measure of total market performance. And this isn't really unreasonable because these 500 largest firms in the S&P 500, they account for somewhere between 85 and 90% of the total market value of all publicly traded firms. And there's about 6,000 to 7,000 publicly traded firms in the United States, so obviously a lot of the market value is concentrated in these few very large firms. So we can animate this, and we can see across time. Here we're in 1999, how the yield curve has changed in relation to the S&P 500. And we can see here, going into about late 1999, 2000, we can start to see a little bit of a flattening or inversion of the yield curve. So I'm going to pause it right here. We can see that we have a slight downward sloping yield curve where the long-term rates are less than the short-term rates. And one interpretation of this is that bond investors are expecting future interest rates to be lower, and we can think about why that might be. Again, the Federal Reserve may lower interest rates anticipating a recession, or if we're in a recession, the Federal Reserve may cut interest rates to try to help us out of the recession. But during this same period of time, while we had the yield curve inverting, the S&P 500 did not seem to change much. And then all of a sudden the S&P 500 begins to fall, and we still have a slightly downward sloping yield curve. Now, what happened here at this point in time is we had the bursting of the internet bubble of the late 1990s, early 2000, and the market crashed, and we also headed into a very mild recession. And then here at this point in time, we see bond investors are expecting the economy to rebound. They expect long-term rates to be higher in the future. So we see the upward sloping yield curve. However, the stock market is still falling. I'm going to speed it up here a little bit. And we can look here, trying to pick this up at this spot right around here. We had the 9/11 attack. The stock market fell sharply. We can also see the Federal Reserve really was cutting some of the short-term rates. We have a very relatively low short-term rates during this period of time. They've fallen from way up at around 6% back in late 2000. A few months later, short-term interest rates are around 2%, so the Federal Reserve has been cutting those short-term rates. And notice here, the yield curve remains upward sloping, even though the stock market continues to fall. And when the market's kind of hit its bottom, we have an extremely steep yield curve, indicating that the bond market really expects the economy to come out and start performing better, and for interest rates to increase going forward. So we see that the yield curve is flattened out, may actually go downward sloping around 2006. So before the financial crisis, while the stock market was still rising, the bond market was beginning to feel a little bit uneasy about the economy. And here we go into the depths of the financial crisis. And notice that short-term interest rates now are almost zero. And now they are zero as we're in the very depths of the financial crisis. Notice that even though the yield curve is still upward sloping, how low long-term rates are. This is a result of the Federal Reserve policies, quantitative easing. And we begin to see a strong upward sloping yield curve. And then we went through this period of many, many years, 8 years of a bull market, with the stock market recording enormous gains, in fact making up, and then some, all that was lost during the financial crisis. I provided this link to this Wall Street Journal article. It's located in the Blackboard folder for the class. And the Wall Street Journal here is walking us through the latest round of Federal Reserve policy and the impact it had on markets. So again, as we previously discussed, one way to see rate changes and other monetary tools in action is to look at the yield curve. Now, we're examining this region right here in the green, and this is the current cycle. So for many years, we had a policy of zero interest rates, and the Federal Reserve, beginning about a year ago, began slowly raising the rates. And we can see in December of 2015 the shape of the yield curve. So we have short-term rates very, very low, 0 in fact, and our 30-year rates right around 3%. And back then, in December 16th of 2015, our rate target was 25 to 50 basis points. And after this announcement, going from 0 to 20 to 25%, we saw that the 30-year mortgages was about 3.95%. Now, as we go forward, about a month later, we're still into just a month into this rate increase. 30-year mortgages are still about the same, but we're beginning to see the yield curve has started to change quite a bit as investors react to this new higher interest rate environment that we're going into. And we can see that across time, the shape of the yield curve is changing, and the markets are reacting to expectations, what's going to actually happen. Interest rates have actually fallen a bit now in the 30-year mortgage rate. And then a year later in December, the Federal Reserve raises rates again. Now we're seeing the 30-year mortgage up to about 4.2%. The Fed rate target is now 50 to 75 basis points. And we can see that the 30-year mortgage rates are quite high. We can see the yield curve changing shape slightly. Our short-term rates are now reflecting that 50 to 75 basis points target, and we're seeing higher long-term rates as well. And then now that the rate target, Federal Reserve raised rates on March the 15th of 2017, our rate target's now 75 to 100 basis points, or 0.75% to 1% as of March 15th, 2017. Mortgage rates are all the way up to 4.2%. Now, question is the Federal Reserve going to follow what it's done historically? So in the previous cycle of tightening, so we're in a cycle of tightening federal monetary policy because we're tightening policy, raising rates to try to keep inflation under control. In the previous tightening, which began in June of 2004, lasted 2.5 years, and it was almost like clockwork. The Federal Reserve was raising rates. In fact, they raised it 17 times, and the goal was to try to put a damper on these surging housing prices. And you can see this tightening cycle as the Federal Reserve raised rates the 17 times, and they reached the desired effect, and then they left it there. And then we actually went into a recession, and the Federal Reserve began lowering rates again. So we can see the shape of the yield curve throughout this period of time, how it's changed. As the Federal Reserve raised rates, we can see the shape of the yield curve changing. The long-term rates staying about the same until the Federal Reserve got rates to the point that they wanted to be. The 30-year mortgage rate was now 6.78%, and pretty much that killed people wanting to buy houses because the interest rates were so high. And then it seems like almost immediately the Federal Reserve recognized we're going into a recession, so they began an easing cycle of lowering interest rates, and you can see how the rates were lowered here. As we go through time, we can see as the Federal Reserve lowers rates, what happens to the shape of the yield curve. We have a 2% target rate here as of October 2008. You might recall that in fall of 2008, January, February 2009, that was kind of the bottom. And then the Federal Reserve took very dramatic policy, and they cut the rates to about 0. And then we will also have this, our 0 rate period with 0 interest rates. And I'll leave you to read this particular article in depth. Again, I've got this posted in the class discussion page on Blackboard. Excuse me, not the discussion page. This is located in the Chapter 6 folder under course materials in Blackboard. So what explains the shape of the yield curve? Well, there's three theories that are frequently used to explain the general shape of the yield curve. They are the expectations theory, the liquidity preference theory, and the market segmentation theory. Now, the expectation theory simply states that the yield curve simply reflects investors' expectations about future interest rates. So an expectation of a rising interest rates results in an upward yield curve. So again, when would we expect to see rising interest rates? That would be if the economy is performing well. And expectations of declining interest rates result in a downward sloping yield curve. So when we expect to see declining interest rates? As we're going into a recession. So as an illustration, let's suppose that a 5-year Treasury note currently offers a 3% annual return. And investors believe that interest rates are going to decline, and 5 years from now they expect the rate on a 5-year Treasury note to be 2.5%. According to the expectations theory, what is the return that a 10-year Treasury note has to offer today? And what does that imply about the slope of the yield curve? Well, let's consider an investor who purchases a 5-year note today and plans to reinvest and buy another 5-year note in the future. Over that 10-year investment horizon, this investor expects to earn, now let's just keep things simple, let's ignore the effects of compounding for just a moment. This investor expects to earn 27.5%, which is simply 5 years at 3%, that's 15%, plus 5 years at 2.5%, that's 12.5%. We add those two together, that's where we come up with 27.5%. To compete with that return, a 10-year bond today would also have to return 27.5% over that 10-year return, or, again, we're ignoring compounding, 2.75% for each year over the next 10 years to produce that same 27.5% return. Therefore, the 5-year rate is 3%, and the 10-year rate is 2.75%, and we have a downward sloping yield curve. Another theory is the liquidity preference theory that suggests that long-term rates are generally higher than short-term rates because investors perceive short-term investments to be more liquid and less risky than long-term investments. And this has an intuitive appeal. Probably most of us, if we were to invest our money, we'd want to get a higher rate of return for investing the money longer. So borrowers must offer higher rates on long-term bonds to entice investors away from their preferred short-term securities. And then finally we have the market segmentation theory. And it suggests that the market for loans is segmented on the basis of maturity. So there's going to be some borrowers and some suppliers of funds that have a preference for short term, some for intermediate term, and some for long term. And the slope of the yield curve is determined by the general relationship between the prevailing rates in each market segment. So the yield curve is just reflecting how the supply and demand in each maturity segment plays out.